Because when the crisis hits, it'll be too late to protect your wealth. You'll want gold, you won't be able to buy it. If you don't already have a dealer, or even if you do have a dealer, they'll probably be backordered. If you don't have a dealer, they won't return your call. The dealers themselves won't have gold because the mints and the producers will be backordered. You won't be able to get gold at any price. It won't be a question of price or kind of thing. It simply won't be available. Today it's available, and the prices are going to go a lot higher. And so it's a good opportunity to kind of get your gold reserve, put it in a safe place, and then sleep well at night. And when the crisis hits, you won't have to worry. You'll have it already. But you won't be able to take the precautionary steps in the crisis. It'll be too late. We've had two great bull markets in gold. 1971 to 1980, gold went up over 2,000%, from $35 an ounce to $800 an ounce. From 1999 to 2011, gold went up 700%, from about $250 an ounce to $1,900 an ounce. So the new bull market, the one we're in now, started on December 16, 2015. You can actually date it. That was the low, $1,050 an ounce. It's up about 50% from there. So the first bull market was up 2,000%. The second one was up 700%. The new one's up 50%. It has very far to run. This is going for years. But if you just took the average of 2,700 and applied that to the new bull market, guess what? You get to $14,000 an ounce. So my only point is these are very simple calculations. They're historically rooted. They're not made up. But numbers like $10,000, $15,000 an ounce are not pie in the sky. Now that the debt is at the central bank level, again, 1998 took it from hedge fund to the banks. 2008 took it from the banks to the central banks. Who's going to bail out the central banks? And that's really the problem. Your only alternatives are turn to the IMF to basically bail out the world, although that's a slow, difficult, kind of fraught process, or shut the banks. And that's what I expect. They'll close exchanges, close banks, close ATMs, freeze accounts. They'll say we're not taking your money, but we're just going to have a bank holiday, an extended bank holiday, if you will. And people say, that would never happen. And I say, well, talk to people in Cyprus, Greece, Argentina. It's happened many times. In 1933, every bank in the United States was closed by executive order of President Roosevelt. He just said the banks were closed. When he gave that order, he didn't say when they would reopen. People just had to sort of bear with it. Now it turns out they did reopen about 8 days later, but no one knew that at the time. It could have been 8 days, it could have been a month or 2 months. So every one of these things has happened before. Some of them have happened very recently. They happen because there's nothing else you can do when you don't have a source of liquidity. I mean, if you say, well, why can't we just turn to the Fed again? Well, the Fed took their balance sheet in 2008, beginning 2008. They took their balance sheet from $800 billion to over $4.2 trillion. They've only come back a little bit. They're still in the high threes, 3.8, 3.9 trillion. What are they going to do if a crisis hit tomorrow? Go to 5 trillion, 6 trillion? And at what point do you pass an invisible confidence limit where you've destroyed confidence in the dollar itself? The thing with gold stocks is they have kind of embedded leverage because of the way stocks are valued. So gold stocks are a good way to make money from a rising price in gold. You actually should make more than if gold is up to 20%, let's say, gold stocks could go up maybe 40 or 50% or 100%. They could go up a lot more because they have fixed costs and variable costs, and the fixed costs don't increase as the gold output increases and as the gold price increases, and so the margins go up when people apply a multiple. That's one reason you can make a lot more in gold stocks. Having said that, you have to be very, very careful about the selection. I like to say that all gold miners have certain things in common. Geology is what it is. The feasibility study is what it is. The gold quality is what it is. Capital costs are what they are. All those things are the same for everyone. What's different is management. Some gold companies have great management. They know exactly what they're doing. They have a track record. They control costs. Other gold companies, some of them are frauds. Some of them may not be frauds, but they have really poor management. So obviously you don't want to be involved in those. So you do need some source of advice, and it can be research reports from brokers and banks. It can be newsletters written by very knowledgeable editors. You can make a lot of money in gold mines, but you have to be very careful in the selection.
Yeah.
Having said that, I I would make the bulk of my allocation into physical bullion. The problem with this, gold futures, gold options, gold ETFs, I mean, mining companies are real. You own the stock, you own the stock, but all the other gold derivatives, you don't own gold. You have a contract, and you have to read the contract. If it's exchange traded, you have to read the rule book. You have to be a geek like me and actually read the rule book. Every exchange rule book I've ever read, and I've read many, has a rule that says we can change the rules. And you have people like the Hunt brothers in 1980 and the silver prices. They were whining that the NYMEX exchange changed the rules. Well, read the book. They have a rule that says they can change the rules. What they'll do, and people say, well, what if all the people who are long gold futures on the COMEX woke up one day and decided to take physical delivery instead of rolling the contract or canceling it out? They just took physical delivery. There's not enough gold in the warehouse to meet those demands. Well, of course there isn't. There isn't anywhere near enough gold. And the exchange knows that, but they say we're not a source of supply. And if everyone, we're just here for price discovery and hedging and all that, if everyone did demand their gold, what they would do is close the exchange. This is what I was talking about earlier. They would close the exchange. They would send everyone a termination notice. They wouldn't steal your money. They would give you a check for your profits as of the close of business yesterday. But you'd be like, wait a second, I want today's profits. I want tomorrow's profits. This is why I bought this gold for you. Too bad. You would be closed out. You would get the check, but you would miss the super spike, where it goes hyperbolic. You would miss that because they would have terminated your agreement. Same thing with the London Bullion Market Association gold forwards. You call up JP Morgan, say I want to buy a ton of gold. I mean, good luck with that. It'll take them a week to find it, or a month maybe. But they sell the gold on an unallocated basis, and unallocated is a euphemism for no gold. In other words, they might have a ton of gold sitting there, but they'll sell the same gold to 100 people, and it doesn't belong to any of them. But it's there in case one person demands it. They can deliver and get another ton to replace it. What if 50 people demand the same? What if 50 people at one time, and there's only one ton of gold, and they all demand it at once? Well, again, the same problem. They don't have 50 tons to deliver. They have 1 ton to deliver to the first customer. The other 49 are going to get a termination notice, either under a force majeure clause or material adverse change clause, or just any early termination clause against all in the contract. And so they're not going to get their gold either. So gold futures, gold options, gold, unallocated gold contracts, LBMA standard contracts, ETFs, same thing. None of them are gold. They're paper claims that can be terminated, and you won't have the gold when you want it. Physical gold is good. And gold miners are different. I mean, there's real gold there. It doesn't belong to you. It belongs to the miner. But you own stock in the company.